But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold.
Why do central banks hold it? Well, it's a form of reserves. So why don't they hold diamonds? Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Hey, welcome back to the Junius Maltby channel. Extemporaneous ramblings of a madman. This is a video that's got a long time coming. This is I guess you could call it a Junius Maltby versus David Ramsey. I've mentioned him before, and I don't have anything really against him personally. I've listened to some of his broadcasts. I've heard him on the radio at times. And he does have some very astute and good observations and ideas when it comes to mitigating your debt, getting out of debt, saving money, and investing and planning. A lot of those areas he's very knowledgeable on. There is an area that he should accept criticism on that he does lack when it comes to his understanding. And I would say that it has to do with economics, monetary history, and the 10,000-year role of gold with humans as a store of money. And the very fact that gold is money, everything else is just credit, and that we cannot place a blind faith into fiat currencies and the assets that are denominated or backed and valued in fiat currencies, as well as modern markets. I don't think he understands the fluctuations over time, what takes place, and that fiat currencies suffer at the hands of government and statists when it comes to inflation, quantitative easing, central bank fractional reserve practices, and all of those things that devalue and debase currencies over time, how they lose value. And I don't know if he fully understands the values lost through inflation are oftentimes skewed and hidden in foggy and shady numbers put out by government statisticians. We're not going to get into all of that, but we are going to take a look at and break apart an interview that he had with a caller. And if you know how his program works, I've looked into it. You have to call in something like 30 days ahead, and it gives him time to prepare for his conversation with that caller. It might not be 30 days, it might be 2 weeks, something like that. But he does prepare. These aren't like a phone call received and then talking off the cuff. I believe there's a conversation that takes place between him and these callers prior to the discourse you'll see on the show or here. And then it looks like it's something that just happened randomly, but there is some preparation that goes into the phone calls and the information that he presents to the callers. The one we're going to look at is a caller asking whether or not they should buy gold. And I don't believe this is the only time he's received this question. I believe he's addressed it in the past. But I want you, as a Junius Maltby viewer, to see some of the answers that he gives and realize that even a person in his situation does not have the full grasp of the role of gold. The fact that it's truly not, it's difficult. You don't call it an investment. It doesn't pay a dividend. It doesn't earn you interest. But it is the ultimate hedge and preservation of wealth and will resist inflation and the devaluation and debasement of your currency. So we're going to look at that interview, look at some charts here, and just discuss the fact that he paints gold in a light that I believe is inaccurate and unfair. And going into this, I don't even believe he realizes, because he mentions some dates, and you'll see that, gold was truly only legal to own since 1974 here in the United States. You know, it's been assaulted by government mandates and laws over time. If it was left on its own, unfettered by government intrusion into the marketplace, gold would have a completely different valuation and price discovery today. And eventually that is going to happen. I don't think he sees it or knows about it, but it will occur. And of course, gold is the ultimate truth teller when it comes to the value of any currency. Because again, currencies are empty. They're just government promises. And it seems like individuals like Mr. Ramsey place, and I think, an inaccurate amount, let's call it that, an inaccurate amount of faith, because that's what it is. He puts an inaccurate amount of faith into the US dollar and fiat currency markets. So let's just get right into it, and then we'll bring these charts up that you've seen here play by as we discuss it.
Gary is with us in Mesa, Arizona. Hi, Gary. How are you?
Hey, Dave. Good to be able to talk to you.
You too, sir. What's up?
Well, my question is it a good idea to invest in gold and silver, like a Roth IRA? And I don't know if it's a good thing. I think it's tangible, so that's my question.
It's what?
It's a solid piece. You know, is it a good idea to invest in gold or silver?
No.
We'll just pause it right there. Note the date that this video was made. His answer was no. It's not a good idea. This was April 11th, 2016. It's when he put the video out. I'm assuming it was produced possibly in that week or the week prior. It's received a significant amount of views, 147,280. But again, note the date, April 11th, 2016. We're coming up just under 5 years from that date. We're about 4 years and change. So I want to look at, what was gold's price when he told this guy not to buy it and that it's a bad idea. Around April 11th, 2016, if that's when the video was broadcast, the price of gold in the US dollars per troy ounce was $1,247. And then if you look down below, up to about April 14th, it was about $1,240. It fluctuated in that range. As you know, gold goes up and down based on the quotes. Now I'm going to look at a 5-year performance for gold. This is from goldprice.org, and this is quoting it on yesterday's close. In the last 5 years, coming up on this again, we're looking at a price change of $742.87 increase in the green for gold. It's up 65.4% so far. During the peak of this year, it would be closer to around 70 or so percent. As you know, gold's somewhat down from the all-time high this year, over $2,000 an ounce. And you know that all of the banks and major financial institutions are predicting gold to smash through that $2,000 and eventually close in on $3,000 and $4,000 an ounce. When you look at the economic backdrop of quantitative easing and stimulus, currency debasement, zero interest rates and negative interest rates, and the state of the global economy, gold only has upward movement from here, a significant bullish trend. And as you can see, he was absolutely wrong in saying that it was a bad idea or no. But let's go into further details through the phone call and conversation.
Here's a couple problems with gold and silver. One is anytime you're analyzing an investment, if you're buying a piece of real estate or you're buying a stock, which I don't buy single stocks, but you could look at a single stock, or you're looking at a mutual fund or whatever, any kind of an investment you're putting money into, you can look at, and you should look at its track record, what it's done in the past, to get an idea of what it's worth today. Okay? And to get an idea of what it's going to do, in the future. And, if you look at gold prices, I just pulled them up, they are all over the place.
So he pulled up the prices of gold and he says they're all over the place. So maybe it was a down day. I don't know. But in 2016, there was a little bit of volatility. Again, we were on the tail end of a major economic crisis where banks had to sell off major portions of their metals to cover margins and losses in other areas. Prices quickly recovered, and we identified a significant bullish movement even back then, if you remember, in being part of this channel. So here is a chart, gold price performance percentage annual change. As you can see, it averages 10.8% just in US dollars and upwards of 11, 12, 13, and 14% in other major currencies. And that's year on year, every year. That's the average gain, 10 to 14%. And this is looking back 15 years. Now, I'm assuming that what Mr. Ramsey was looking at was that 13, 14, and 15 range. Again, this video that he produced was in 2016. It did close that year up 9%, but in those previous years, it was coming down off the all-time highs and a lot of volatility because of the past economic crisis. But if you look at overall, again, over the last 15 years, in 2005, 2006, 2007, we're looking at 20, 23, 30% gains. 2008, 5.6% gains. Again, the markets collapsed, lost tremendous value to anyone who was exposed in the indexes, mutual funds, like he promotes often. 2009, 23.4% gain. 2010, 29.5% gain. 2011, 10% gain. 2012, 7% gain. We had those few down years, but it recovered. 2016, up 9%. 17, 13.6%. 2018, dipped a little bit, just 2%, nothing much. 2019, 18.9%. So far in 2020, we're up 23.6%. My guess is we're going to close this year in the high 20s, possibly in the 30% range gain, with 2021-22 also looking for significant bullish movement, just like you're seeing in this chart. So when he says you have to look at the past performance, I would say that this is a pretty good indicator that gold is doing quite well. So we'll take a look at two other graphics that I think will display my sentiment here. Again, this is gold price performance in US dollars. Now, in the last 30 days, we've had some volatility. As you know, the markets have seen their fair share of it as well. But over the last 6 months, just in the last 6 months, when the markets suffered dramatically, we also saw gold rise 11.25%, up $189.94. Over the year, gold is up $367, up 24.3%. Look at the last 5 years. Again, he made this video almost 5 years ago. Since then, gold's up $742.87, up over 65%. The last 20 years, gold's up $1,614.17, up 610%. And it's also, I mean, we haven't even gotten into how safe it is. Gold never goes to zero. It cannot go to zero. Stocks, indexes, mutual funds, ETFs, all of those things can completely implode. Even oil, other commodities like that can be destroyed, and funds that are measured in those commodities can be annihilated. People have lost significant wealth just in oil ETFs. But we're not talking about those. We're talking about gold, the eternal money, the money that's literally mentioned in the first books of Genesis. It's been with man since the beginning of time. So when you look at what he just said about looking at the track record, I would say the track record and the resume for gold is brilliant. It's absolutely beautiful, especially since it's only been legal to own in the United States as a vehicle like this for investing since 1974. You cannot look beyond that. That was a different time. From 1933 to 1974, you were prohibited from possessing gold in the ways that we view it today. So you can't really compare it to Dow Jones Industrial Performance and such prior to that. We have to start the race at the same starting line, which is, I would say, around 1970s. And again, there's been a lot of changes. A lot of things have taken place economically and in the world since that time. The breakdown of Bretton Woods and the baskets of currencies that float freely, not backed by anything but empty government promises and the manipulations of politicians. But let's continue on here. I just wanted to show you the resume of gold, and when you look at a chart of it, again, the chart showing significant bullish uptrends and dramatic performance over time. And even from the 90s up through the mid-2000s, it was just very stable, a very safe place to just hold your money and not lose anything. If anything, just to maintain your purchasing power and your wealth over time. This isn't something you're buying to flip on a weekly or a monthly basis. You're not selling this, 3 days after you buy it or 6 months later. This is something that is for dynastic wealth preservation over time. And it's quite different from the funds and the other investment vehicles that Mr. Ramsey likes to promote and talk about. But let's continue on here. Again, this is a gold chart dating back to just prior to 1992. This is a 30-year gold chart showing you the dramatic uptrends over that course of time.
And up and down and up and down, and right now they're way down again after
the stock market, huh?
After an all-time high.
So he took a quick look over at his computer because he doesn't follow gold and doesn't know what the price is, and I guess he just looked at the day movements or whatever chart he had pulled up. But as you can see here, and we've discussed this in the past, in the last 15 years, gold has only seen a total of 4 down years. That's it, 4 out of the 15 years being down. And you're going to see here that gold outpaces the Dow significantly with many of its up years. Now these 4 down years combined equal about 42.3%. That's it. Of all those years that were down, just those 4 equal about 42.3%. But all the up years outpace that and create a yield of about 10.8% in the green right now for gold. Well, how does the Dow compare to that? Let's look at some of the Dow's performance going back over the last 15 to 20 years. Now, to be fair, these are completely different vehicles, right? I mean, one is gold and the other one is, well, the Dow Jones Industrial Average. Here you can see, just going back to 2011, we have 3 down years, 7.14%, 5.63%, 2.23% for the Dow. And then you have in 2008, it fell 33.84%. 2005, it was down 0.61%. Looking back from 2000, 2001, 2002, significant drops of 6%, 7%, 16.7%. So not doing very well there. It had to make up for that recession period we saw in the early 2000s. Now this adds up to a total, and I'm just going to I'm going to exclude the 2000, 2001, 2002. Just going back to 2005, we have 5 down years. So that's more than gold. Gold only had 4 down years. We have 5 down years for the Dow, totaling 49.7% decline. So again, 49.7% down for the Dow if you add up all those down years in that same time frame, compared to only 42% down for gold in that same 15-year span. And again, looking at gold, going back to just prior to 2002, you have 1, 2, 3, 4, 5, 6, 7 down years total. Just in this snapshot you can see here with 2008 really bleeding red for the Dow.
And when you look at the track record, say over 50 years, if you put money in gold 50 years ago, or you put money in a growth stock mutual fund 50 years ago, or you bought a house.
Now, to use the 50-year thing is completely inaccurate, unjust, unfair, and is discarding a lot of historical facts that need to be included in the conversation when discussing gold. I don't know if he's aware that you couldn't buy or invest in gold in the way he's discussing it 50 years ago. I'll reiterate, gold was not legal to own in the United States until about 1974. Before that, the reason gold was essentially flat on any price performance and held at $35 to $42 an ounce was due to government mandate. It was only valued by those that held it, central banks, at $42 and so per ounce. After it was allowed to be traded and brought onto the free market for what we could consider somewhat accurate price discovery, even though we know that it's manipulated and that there is a lot of government laws intruding on the true ability for gold to perform the way it should. And that's not a conspiracy theory. That's actual, tax laws, trading with the enemy acts, and a lot of laws done by government to try to discourage investment and holding of precious metals. That aside, again, gold was only really on the market, and you can only look at it in a historical sense as it relates to the Dow and other things, from about 1974 onward. So you can't go back 50 years. When you look at if you had bought a house, I love when people say that. Well, if you bought a house, where, Dave? I mean, real estate varies by region. Some places have lost half of their value. I mean, would you have bought a house in 1970 in Flint, Michigan, or Detroit? Would it be worth the same today? I don't know if you'd be doing too well. It's probably abandoned, and you probably couldn't give the property away at this point in time. At other times in history, people purchased homes during significant bubbles. If you recall the 2007, 2008 time period, 2006, 2005, prior to that, everyone was saying you got to buy a house, you got to buy houses in California, you got to buy houses in Nevada, all of these places, Florida. Some of those people bought homes for $1 million that they couldn't give away for $300,000 afterwards. I had a close friend who bought a home in Bend, Oregon, and he ended up having to give it back to the bank, declaring bankruptcy and losing a significant amount of money due to the previous housing crisis. So buying houses is not always a great move. You have to really look at the market, look at if there's a bubble taking place, what is housing going to do in the future. I think a lot of it is unsustainable, some of the values we're seeing, and the only reason they exist is because of central bank activity, zero interest rates, easy credit, ninja loans, ARM loans, all of that. That's another conversation. But again, yeah, housing, real estate, that can be a good investment sometimes, but that might not be the goal someone has. They might want to have liquid wealth that's transportable. Not everybody wants to have a house or a rental. So it's not for everyone. And again, it's not a fix-all, a cure-all. It's not a guarantee. The funds he's discussing, oftentimes, they've hemorrhaged significant amount of money. They're tied to the indexes that we're looking at. Today we're just really looking at the Dow in these comparisons. I know there's the NASDAQ, the S&P. There's various other funds and things you can look at. But it's difficult when you can cherry pick all the different asset classes out there in comparison to gold. When gold is standalone, it's by itself. It's money for 10,000 years. A lot of times gold bears will do this. They'll just kind of attack gold coming at it from what I would consider very inaccurate starting positions, like we just heard, 50 years. Well, you can't use 50 years. Sorry, Dave. You couldn't get gold 50 years ago. The price of it was fixed by the government 50 years ago. You have to start it from 1974, and then look at real estate, and then look at the indexes we're talking about. And I'm not saying gold is this outlier when it comes to performance, that it's this great mystical thing. Yeah, it doesn't yield that much, but it's safe. It never goes to zero. We've seen over the last several charts that we just looked at, it's going to yield around 10 to 11 to 14% in various currencies. It is global. It's respected and recognized worldwide. It's transportable. There's a reason central banks hold 19% of the physical supply of all gold ever mined since the beginning of time, Dave. They don't hold gold out of tradition like Mr. Bernanke inaccurately stated in the beginning of the video. Gold is money, and they know that. And the people that don't hold any gold, those like Dave and those that listen to people like Dave, are going to be left in a very serious predicament when the economic model, the experiment that we've lived in since the breakdown of Bretton Woods, finally comes to its crashing conclusion, when fiat currencies are debased and devalued to the point of non-existence, to the point of a value of zero. I don't care how much Apple stock you own, Dave. I don't care how much Tesla stock you own. I don't care what little mutual fund you own. When the dollars it's denominated in are worthless and purchase less goods and services because the currency's been destroyed, it's similar to playing musical chairs. And when the music stops, you're going to be left without a chair. And those that held gold for the long term will have a place to sit. And they'll be very relaxed, very comfortable, and they won't be stressed out.
50 years ago with the exact same amount of money. So we took $100,000 and we put it in there. And you visit 50 years later, you would find that gold has about a 2% rate of return over that 50 years.
All right, let's play Dave's game here with this 50-year window of time. Going back 50 years ago, pretend for a moment you did break the law and you purchased some gold and you held some gold here in the United States anyway in 1970. It would have been $35.96 an ounce. $35.96 an ounce. That's the quoted price for gold in 1970. In 71 it was 40. In 1972 it was 58. But again, this is $35.96 an ounce. Let's do the math here and see if he's correct. So we were given $100,000, right, to put into gold or real estate or something else. You took that $100,000, you wanted to preserve your wealth over the course of 50 years, And let's say you bought gold at that $35.96 an ounce. That would equal around 2,780.867 ounces of gold. 2,780 ounces of gold. At today's value, now this is yesterday's quote, $1,878.90. Again, gold's down this year. It would have been much more than this about a month ago, 2 months ago. But again, we're going with yesterday's quote, 1878 times 2,780 ounces of gold. What do we got? Your $100,000 in gold that you purchased would equal $5,224,972.19. Now that's not chump change. That is significant amount of money, my friends. $5,224,972.19. Now that's a growth of about 5,124.97% total overall. Again, 5,124.97%. Now this isn't compounding yearly average percentages, but if you divide that growth of 5,124.97% divided by 50, you're looking at about 102.49% per year on average. That's your, again, this isn't compounding interest rate. This is the total growth of 5,124.97% divided by 50 years equals 102.49% per year. Now, I know some math nerd or boomer like Dave Ramsey is going to get all up in arms about that and say, well, we were talking about compounding interest rates and it's just 2%. Gold only yielded 2% over 50 years. That is entirely 100% inaccurate, because here you have a compounding interest rate calculator showing a current principal and initial investment of $100,000 with zero additional growth, or you're not adding to it at all. Zero additions, no other payments. You just started out with $100,000. You bought that gold at $35.96, and you have 50 years for it to grow. Now, I put in 8.23% for interest rate every single year. That's 0 down years, and you get a close value. So we had a total growth that $100,000 in gold you purchased was worth $5,224,000, respectively, $5,224,000. Now, if you look down here, the future value that I could get close to was $5,216,000 and $544 there. So $5,216,000, pretty close enough, and that is an 8.23% year on year, every single year for 50 years. So it's nowhere near the 2% Dave Ramsey quotes, the accurate measurement with all of the math. That's the great thing about math, is it doesn't lie. It's 8.23% respectively, give or take fractions of a percentage here. But that makes sense. When we look at the last 30 years of gold averaging, but again, the last 15, we look at the previous charts, gold averaging 10 to 14% per year, and it's getting more and more. It's increasing, that percentage gains with gold, just because of the erosion and destruction of currency. So I hope Dave can realize that he's absolutely mistaken and wrong, that gold did not yield just 2% since then. If anything, it's yielded 8.23% every single year, over 50 years. And remember, much of those years back then, gold was held flat, and the values of it were not allowed to move in accordance with true free market activity because of legal reasons.
Really?
Yeah, it's just
wow.
It's done horribly, and so, but it's pitched off of emotion, where people say, "Oh, if the economy crashes, at least I've got some gold."
Right.
And the problem with that is that's also mythology, because when an economy crashes, no time has gold been used as a medium of exchange on a crashed economy since the Roman Empire.
Dave Ramsey's grotesque lack of knowledge when it comes to history, the history of money, the flow of gold throughout human existence, going back to the beginning of time, essentially, is staggering. At no time has gold been used since the Roman Empire, he says on a crashed economy. That's entirely not true. First off, Mr. Ramsey, gold has been money predating the Roman Empire and was money up through almost the entirety of the last century, only to be taken out of circulation by government mandate and tyrannical statist laws passed by those like FDR, who needed to ban gold in order to further their welfare warfare state and fund big government and be able to inflate unbacked fiat currencies. You're completely mistaken, Mr. Ramsey, that gold was not used. It was the basis on which all currencies were backed by around the world, whether it was Spain, Britain, the United States, France, Belgium, Germany, all of North and South America. The United States Constitution outlined that only gold and silver coin could be money. It really is mind-blowing that, and this just, to me, this shows you again, this is oftentimes what you'll run into with the anti-gold crowd. They come after gold and they'll make statements like he just did that are completely untrue, completely unfounded, and have no basis on what history really was. And to me, you can't have a rational, logical, articulate discourse with an individual as misinformed and as biased as someone like Dave Ramsey is towards gold.
You can't find it. So, because what happens is, let me give you an example. For instance, during the Civil War, the South, of course, tried to break away, formed their own money, and there were Confederate dollars running around, right?
Right, yeah.
And, so when that all started falling apart, and, of course, the Union won the war, you know what happened? It wasn't people started using gold. It was that they started using Union dollars.
Now, I don't have time to give Mr. Ramsey an entire history lesson covering Supreme Court cases like Knox versus Lee, Hepburn versus Griswold, what happened during the course of the Civil War with the hoarding of metals, fractional reserve currency, and the entirety of U.S. money, paper money, backed by gold. But I'll show you a series of bills here. There's many more that I could put up, all of them declaring redeemable in gold as gold certificates, as gold bills. You see, back then people understood that all paper money was backed by metal, by gold. It was payable to the bearer on demand. You could go to the bank and exchange that bill for X amount of gold coin. It was declared that the bill just represented gold on deposit at the said institution. So when he says people weren't using gold, they were just using Union dollars, those Union dollars, those Union bills were backed by gold, and you could redeem them for gold. So they were, in fact, Mr. Ramsey, using gold. That's how the economy functioned. And if you look at the definitions of the currency names that exist in the Constitution, we know that a dollar was a specific weight in silver, eagles and half eagles were specific weights in gold, and all of the bills covered that. You didn't have to explain it to people. They just knew. It was assumed that when you were given a $20 bill, you could then, if you wished, take it to a bank and exchange it for $20 in gold coin. So his entire statement there regarding people not using gold after the Civil War is false. It's wholly inaccurate. And it just, again, it exposes a significant flaw and a lack of understanding of American history and how money worked in the United States. So once again, I will reiterate, you cannot have a very good conversation with these people, especially because a lot of times they have a pretentious ego and they're very arrogant on their position and their understanding, and a false sense of intelligence when it comes to the topic of which they are discussing. Now, I'm not going to go toe-to-toe with Mr. Ramsey on stocks. I can really give two hoots about his portfolio and mutual funds and stocks and bonds and such. But when it comes to monetary history and the role that gold plays in it, and the relationship humans have with gold, I can tell you this: he doesn't know anything. Now, any student of economics, anyone who looks at history and economic collapses, currency debasement, currency collapses, is quite familiar with the myriad cases of them. There's websites that list the hundreds and hundreds of currencies that have been debased to values of nothing, zero. And every single time, gold skyrockets in its value being related to those currencies. Happened in Germany, it's happened in Zimbabwe, it's happened in Bolivia, the list goes on. Argentina, every country where the currencies have collapsed, gold rises significantly in value and gets to the point where no amount of fiat can acquire physical metal at all. And oftentimes, as we've seen in the last several decades, some of these nation states that have succumbed to hyperinflation and collapsed, the population itself resorts to melting down jewelry. They end up, as we've seen in other nations, panning for gold outside of jewelry shops, or like in Africa, panning for any gold they can find just to buy bread. You can look these cases up. I'm not going to display them all here. I don't have the time to address every single inaccurate statement Mr. Ramsey has made. Let's just say that every time there's been a currency collapse, large portions of the population have resorted to barter, and in order to preserve wealth, have either held or acquired metals, and just to purchase everyday goods and services, have had to somehow find another medium of exchange that wasn't that currency that had been destroyed. And that is why, again, you can look up the situations in Africa where the population was panning for gold just to buy bread. So again, absolutely inaccurate, absolutely mistaken, no understanding of what actually takes place in these situations. And it really is a good topic to bring up the normalcy bias. He's never experienced it, thus he believes it can never happen. And we're somehow in the United States immune to such economic forces that would create that type of environment.
I have a Green Beret stopped by here the other day that was in Iran when Saddam fell, and he brought me some money, some paper money with a picture of Saddam on it.
Okay.
And of course, you and I know what that money's worth. Nothing,
Yeah.
right? But guess what replaced it? It wasn't gold. It was another paper money, another coin. With the new government. And that's what ends up happening. People place their trust in something, and really, when you place your trust in that thing, it's because you think you can exchange it with someone else.
Placing trust in something, faith in something that you believe you can exchange with someone else. That same sentiment goes for paper money. You believe, you have faith in it because it's unbacked, that someone else is going to take it for goods and services. And you're also placing faith in government institutions run by men, which are prone to failure, which are prone to theft and inflation and other exercises in absolute debasement and devaluation of the currencies. Now here's a bill, a Saddam bill, that people place faith in, similar to a US dollar that people place faith in. There came a time where it was no longer able to be exchanged for goods and services. Now, who is to say that the dollar is immune to the effects of economics that could one day result in it no longer being accepted for particular goods and services? I'm not going to get into the whole thing with the legal tender laws that force you to take U.S. dollars and force your contracts to abide by U.S. dollar legal tender laws. We mentioned two of those Supreme Court cases earlier. I'm sure Mr. Ramsey's never heard of them or explored the writings surrounding those cases. Now the thing is, most of the time, populations are forced, yes, forced, which means you will either be killed or taken away and put in a cage if you don't abide by the edicts of the state. You're forced to use certain currencies. And I'm sure there were portions of the Iraqi population that did barter or did use gold and exchange gold. And the thing is, if they held gold or converted their wealth from these Saddam notes into gold at some point, that gold still held value on the world market. And believe me, Dave, there's always buyers for gold. You can see it every day on the tickers and the exchanges. The global gold trade never sleeps, it never dies. It hasn't for 10,000 years. There will always be someone on the other end of that trade willing to separate you from your gold for something. It is the eternal money. It has never gone extinct. It has never gone to zero. That's something that fiat paper cannot claim, because all fiat paper eventually reaches its intrinsic value, which is zero. So to say that they didn't use gold in Iraq, that's his one case, his one example, because he knew some ranger or some Green Beret that was there when it happened. There is that one story is what we should base economic and monetary policy on, what took place in a desert 5,000 miles away that had just been toppled by the United States and was in the midst of chaos. I don't think that's a very good example, and I don't even think it's very accurate as it relates to the topic.
You can trade it. But at no time have we had a situation where you would take a bag of gold down to the gas station and fill your car up. We've never had that.
Yeah.
And so...
Well, you know, it's like everybody says, well, the dollar's worth nothing, but gold and silver back it, so it is worth something.
No.
I wasn't for sure.
Yeah, it's no longer based on the gold standard. It's only the only reason a dollar's worth something is because if I've got one and you want to sell something, you'll take it.
The bag of gold statement. I love that. That's a common thing uttered by those who have no understanding of the value of gold, especially with the backdrop of an economic collapse or currency debasement. Nobody walks around with bags of gold, Dave. Number one, a bag of gold contains millions of dollars in purchasing power today, right now. Most people seldom ever clutch even a 1-ounce gold coin. Most goods and services are acquired for much smaller amounts of gold. I mean, there's a reason the most common denomination for nearly 1,000 years were gold coins under a 1/4 ounce in weight. And even then, a British sovereign at 0.2354 ounces of gold purchased a significant amount of goods and services, had a very strong purchasing power for its size. And the reason people aren't taking gold and silver coins, well, there are many that will. I can assure you, if you went to someone to purchase gasoline for your vehicle and had silver change with you, they would take it for that weight. You see, the free market, Dave, has a way of working things out on its own. And the purchasing power of metals exists outside of the dominion of government. The only thing the governments can do is pass laws to inhibit citizens and inhibit the right of free trade and inhibit the right of private transactions. You see, legal tender laws intrude upon that. The trading with the enemy law intrudes upon that. People quite often around the world barter and negotiate and use precious metals in the form of exchange. I myself have purchased goods and services with precious metals. I've engaged in trade, and I have either bought or sold items for precious metals in the past, and many have done so. It's quite common, as a matter of fact. Even on things like Craigslist, it's common. And that's not to mention cryptocurrencies are now finding their way into that realm where people can escape and use things outside of the fiat empire to engage in transactions. Anyone who comes up to any viewer of this channel to purchase, let's say you're selling a new vehicle, you're selling your used truck. I've used this example quite often. And a guy has the opportunity to give you either $5,000 in cash or let's say 2 or 2.5 ounces of gold. The 2.5 ounces of gold is what I would prefer to take in exchange for that truck. I think many people would. And there can be ways that is done. We've discussed that at length here in the past. So again, and this whole thing with him talking about the dollar being unbacked, yeah, it is. It's unbacked. And to have faith in it is insane, because you have faith then in the U.S. government, which you've seen how broken, decrepit, and degenerate they are. I mean, we have guys like the Bidens out there doing the things that they do, smoking crack and losing laptops and criminal activity, everything from the Hillary on down. I mean, the entire apparatus of the United States government, Congress. I mean, you've seen the pork, the shady deals, the disappearing money. We've seen the debasement of the dollar for the last 100 years just ongoing. $27 trillion in debt that is unserviceable, interest that is off the charts, debt to GDP ratios that are nauseating. So, he places this faith in the dollar like everyone's going to receive it, everyone's going to take it forever in perpetuity. And that's just not the way it is. The dollar's the leper with the most fingers left. The dollar is dying, Dave, and there will come a day where nobody wants your dollar. I don't want your dollars right now. And things are, well, not even that bad yet. So you just wait. Just wait. Wait a few years.
That's the only reason it's worth anything. It's a trust transaction, in other words. And so then that makes gold being boiled down to anything. It becomes in the investment category. What we call it is a commodity at that point. And so like a bushel of wheat is a commodity. And you can buy futures on commodities, or you can buy actual barrel of oil. Okay, and you know you hear oil's down right now because you've seen gas prices go down. It's because oil prices are down, but that's a commodity, and oil goes up or down based on demand, and gold goes up and down based on demand, not based on it making money.
At this point, I will direct you towards at the conclusion of this video, researching the 1966 letter by Alan Greenspan on the properties of gold as money since the beginning of time and why gold found its role in that. You can also look up the video on this channel. I've done that letter and read it to you, as well as the viewpoints of Karl Marx on the role of gold and why gold became money. The fact is, to call it a commodity is inaccurate, and I've actually done a video on that, gold as a commodity or not. You see, gold doesn't rot like wheat. It doesn't perish or go bad or mold. It's not difficult to store gold, where it is very difficult to store a significant amount of wealth in wheat. It's difficult to store oil. Who wants to store barrels of oil in their garage? Not me. And for him to say that gold is just linked to commodities, and it's just a commodity like them, and it goes up and down on demand like a commodity, is again inaccurate. Gold also rises and falls as it's related to the strength of the currencies that exist out there. As the dollar weakens, as it's devalued and debased, as we've seen, as the charts show, as the history of the dollar strength has shown, we've seen the price of gold rise dramatically. Gold often behaves in relation to the strengths of the dollar. The strength of the dollar oftentimes can be viewed through the value of gold as it relates in dollars. Gold is flat. It's a straight line. It doesn't go up and down. The values of the currencies required to purchase it oftentimes rise or fall. And as those currencies are further destroyed, the value of gold will rise against them. And the part about gold, quote, making you money, it doesn't make you money. It doesn't earn a dividend or pay interest. Gold maintains and preserves your wealth. It's the ultimate hedge. It's the ultimate protection against the loss of wealth by the thieving hand, that hidden hand that slips into your pocket called inflation, the inflation tax. Governments destroying the currencies we're forced to use, robbing Social Security and pension funds, and destroying the amount of goods and services you can buy with those dollars. Gold stands between you and the evils of inflation. It protects wealth. That is something I don't believe he fully understands. It's not an investment in that regard. It's a hedge. It's a protection. It's the fire insurance you don't want to use, but if you don't have it, you surely will wish that you did.
Because gold doesn't make money. It's only based on somebody. If more people are chasing gold, the price goes up. If more people are running from gold, the price goes down. That's the only thing that drives the price. Same thing with oil.
First off, central banks aren't sitting on tons of wheat or tons of oil. Central banks sit on 19.5% or more, nearly 20% of all of the gold ever mined since the beginning of time. And the way the price of gold is often discovered is with the various bank calls between the major banks, the London Bullion Metals Exchange, New York, and the price is discussed, and there's the buys, the sells, and it's discovered. Now, again, there is some government intervention based on laws, tax structure, and other things that have major effects on the price of gold. For him to say that more people buying it, selling it, and that's how price is discovered, very, very simply putting the supply-demand curves with gold, that is true to an extent. However, very few people own gold. Very few people have access to gold, and they don't understand gold. Less than 1% of Americans have ever held any gold outside of jewelry. As he sits there and tosses his ring in the video, you'll see him touching what I assume to be a gold ring. There is not this tremendous shift of populations going into or out of gold. It's not in a bubble state. And it's not dictated by these populations, really. The gold market is much bigger than that, and it's much more sensitive, again, like I've discussed, to currencies, the value and the purchasing power of currencies, and the health of various economies and governments. And the price is often discovered by those who truly understand the value of gold and have control over currencies, over policies, and know the future of certain economies. There's a reason why we saw when the repo markets broke down earlier in the year prior to the COVID situation, the wealthy privately vaulting gold, taking gold off the market, out of ETFs, and privately vaulting it. Now, I'm not talking about the people that call his show, not even him. And I'm not even talking about people like Shaq. I'm talking about the people that are so wealthy, they're the ones that write the check to the guy that writes the check to guys like Shaq. I'm talking about the true wealthy in this world, the ones that actually know the value of gold. As Jim Rickards says, he's never met a billionaire that doesn't hold gold. These are the guys that know. These are the guys that truly understand wealth. They're not the guys, running a series of flop house rentals in a ghetto someplace. And I'm not going to get into the risks of real estate markets and how certain rentals can go to zero tomorrow, or the neighborhood could be abandoned tomorrow. Real estate's one thing. Yeah, it's great. If you want to have a couple of rentals, go for it. We're talking about wealth preservation here. We're talking about how gold is truly valid, and his statements against gold are both misinformed and inaccurate and show a lack of understanding when it comes to the role of gold and its history. And it's not your typical commodity. And again, I'm going to have to point you to the video we did in the past on gold, whether it's a commodity or not, and the differences of that.
Is a supply-demand curve drives that. And so for that reason, commodities in general, oil, gold, silver, diamonds, anything that falls in that category, the only way it makes, like a rental property makes money.
You have to love when the diamond thing comes up. Oftentimes people that have no understanding of gold will mention the diamond situation. Big difference is diamonds are made of carbon, one of the most common elements in the entire universe. Diamonds can be made, manufactured in a laboratory. It's difficult to be able to discern a man-made versus a real diamond, or even cubic zirconium, or a fake crystal of some kind. They really serve not much other purpose. They've never really functioned in it as a role of money. And again, Greenspan's article in 1966 does touch on some of these attributes. The fact is, diamonds as a market are tightly and highly controlled by the jewelry industry and some of the largest jewelers and diamond dealers in the world. Another fact is there's enough diamonds for everyone on Earth to have like a coffee mug full. They're not particularly rare. So as a matter of fact, a 1 ounce gold nugget is more rare than a 1 carat diamond in the wild. That's just another little gold bullion fact for you there. So for him to do the comparison with diamonds, it's a jewelry market. It's fluctuated much on luxury demands, whereas gold, central banks don't hold diamonds, they hold gold. The diamond conversation, again, it's a very elementary and beginner's viewpoint when it comes to trying to address or discuss relationships, comparing it to gold. And it's one that you just have to deal with. You'll wrestle with it when you come up against people like Dave Ramsey.
Right. If you buy stock in a company, that company is making money, so that stock makes money. You buy stock in Apple, they're selling the crap out of phones, right? And so billions of dollars. And so by owning a little piece of Apple, when it makes a profit, there's money going on there. But gold's just sitting there.
Now, I could get into the ethics of stocks and buying certain companies that you might have ideological opposition to. Some people are opposed to owning stocks in things like Raytheon or major defense companies because they're manufacturing weapons and engaging with the military-industrial complex and creating bombs or missiles systems that destroy and kill human lives. And then there's companies you might be ideologically opposed to because of their political views and what they do, what they contribute to. Apple is a good example of that for myself. I wouldn't buy Apple because of the political slant of the company and what I know they contribute to. So I have no desire to make money off of them or to loan them money and purchase their stocks. But let's just talk about them as a stock because he mentions Apple. This year, they've ranged from $53 to $137. The previous close, according to this here, was $115. It's at $108 now. Earlier he talked about the volatility and the fluctuations in gold. Well, you can see here, Apple is a little bit volatile. It's gone up and down this month. It's in the red. So far this month, it's down almost 7%. Some of the headline news: Apple loses $450 billion in value since record on iPhone woes. Why Apple stock dropped today. The difference between, like I said, he said gold's just sitting there. Well, it is, Dave. That's the point of gold. It's just sitting there, not losing value, not being stolen from you, and it can't go to zero. The difference between gold and a stock is a stock can go to zero. I saw people get wiped out holding various ETFs this year with things like oil. Other stocks have been annihilated. I looked at a stock the other day. It IPO'd at $14. It was a Canadian stock. It's worth 17 cents today. Completely wiped out, annihilated, and it'll probably go to zero and be destroyed. And that happens quite a bit. There's many stocks that go to zero. They IPO, they drop, the company flounders, goes bankrupt. You never know. You're investing in people and you're hoping, you're placing faith in their ability to create a profit or to produce a product that people want. A lot of times that doesn't happen. A lot of times the business itself fails. Gold doesn't fail because, again, it's been around for 10,000 years. It is money. I'll quote J.P. Morgan again. Gold is money. Everything else is just credit. There's nothing wrong with purchasing stocks. I myself have done it to get a dividend here and there, play the game, roll the dice in the casino of Wall Street, because that's what it is. It's a gamble. It's a bet. And there is a risk. Some people don't want that, Dave. Some people don't want to lose and they cannot afford to lose a penny. They want to just hold their wealth. They want to store up the fruits of their labors so that they can turn to them decades later and still have them there. And one of the surest ways to not lose anything, if you really want that insurance and you don't want to have it in the back of your mind that you might be broke or those stocks might go to zero, if you don't have the time to pay attention to them every single day, gold is beautiful. It's truly beautiful in that regard. And I myself, I don't want to loan Apple money. I don't even know if Apple is going to do that well this year. For all I know, Apple could go to $35. I don't know the state of the economy when it comes to how it's going to perform with Apple, but I can tell you, I don't have a lot of faith in their company, and I don't care to own it. But, hey, if you want to buy Apple, go for it.
A barrel of oil is just sitting there until somebody chases it. And that's what drives the price of it, is when people chase it. So consequently, commodities are always more volatile. They always go up and down more, up and down more, up and down more. And that's more than you ask for. But a lot of people are asking me this question, so I used your question as an excuse to go up on a soapbox, okay? But bottom line is, I don't own any silver or gold except I've got one really nice gold watch. But I don't own any as an investment at all.
It makes me smile to know that Dave Ramsey doesn't own any gold, and he missed out on these beautiful gains every single year, 20%, 30%, 29%, 13%, 23%, with an average of 10.8% year on year. Significant gains, a lot of up years, more up years than down, more up years than even the Dow had. And a chart like that continuing to go up, trending over time, and as dollars become less and less valuable, purchasing less and less goods and services, as the dollar continues to be debased and devalued by those in Congress with stimulus after stimulus, quantitative easing infinity, as modern monetary theory intrudes upon the minds of those in the power of government, we can only rely on one thing: gold, because the dollar will be destroyed, and the markets that are valued in dollars will suffer accordingly. And when you sell a stock for dollars, what are you going to be able to purchase with those dollars? How much will those dollars have value?
In any stretch, because it's got a poor rate of return, and there's nothing that drives the price except people's fear or greed.
A poor rate of return. Well, here's that $100,000 Dave gave us to invest back in 1970. with not a penny added to it. Just $100,000 in gold locked up. You never looked at it again. You stuffed it in a box under your bed. It's worth $5,224,972 today. That's his poor rate of return. An 8.23% compounding year-on-year interest rate, unfettered, unabated, with $5,224,972 in value. And when you look at the charts for gold, well, we'll bring it up again. Only 4 years out of the last 15 have been down. Other than that, double-digit gains almost every single time. This year alone, we're probably going to see a 30% rise in the value of gold this year. And when he says the only thing that drives it is people chasing it and greed and fear, that's what fuels any market, Dave. You mean to tell me that prices on Wall Street are not dictated by fear and greed? Those are literally the two most common attributes on the stock trading floor. Fear and greed. That is what literally latches on to the hemoglobin within the arteries of Wall Street, is greed. It is their mitochondrial DNA. Pure, unadulterated greed exists in Wall Street. And when you want to talk about fear in Wall Street, all you need is a butterfly to flap its wings in the Middle East, and it throws off the entire price index for the Dow Jones. I mean, think about it. Every time someone burps or coughs or a COVID number comes in or an unemployment statistic, Wall Street goes chaos. That's fear. Meanwhile, gold calmly sits, gaining as currencies continually erode and are destroyed by government. So there you go, Dave Ramsey, 100% wrong. 100% ill-informed on gold. This video's had a long time coming. Maybe I'll do more of them. We'll take a look at how he views silver sometime. We'll talk about that. I know he's got several videos out there. Again, this is for the broadcasting of this is for news and media and commentary. I appreciate all of you joining in on this commentary, on this news feed here on the Junius Maltby channel. And as always, these are unscripted, extemporaneous ramblings and rants. I have no notes in front of me. I don't have anything else pulled up. This is just me sitting here telling you what I believe, what I observe, and what I feel. I hope you enjoyed it. Thanks for taking part in this episode of the Junius Maltby channel. Don't forget to like, to share, and to subscribe. And share the video if you wish to. Take care now.
Hey, man, thanks for asking the question. Appreciate you joining us.